Good afternoon, everyone, and welcome to the first webinar of this AMAS and Building Bridges series on blended finance. My name is Aurélia Fay, and I'm responsible for sustainable finance within the Asset Management Association of Switzerland. And for the first webinar of this series, we'll spend the next hour introducing the topic of blended finance. If one can briefly go to the next slides to introduce the program. So after a few welcoming remarks from the CEO of AMAS, Adrian Schatzmans, we'll hear about why we believe blended finance is a key opportunity for the Swiss asset management industry. We'll then hear from the head of private sector development at SECO, Liliana Kirchknopf, about why blended finance matters to Switzerland. And then we'll deep dive into the technicalities of blended finance structure through the expertise of Clubb, managing director of Convergence, in order to understand how those blended finance structures actually work, what are the key approaches out there to reduce risks and improve risk return. We'll then tackle a concrete case, learning from the experience of Allianz, an IFC facility, in order to understand how implementing a direct debt blended finance instrument actually work. And the lead portfolio manager for blended finance at Allianz Global Investors, Leticia Ferreras Astorqui, will go through the key lessons learned and recommendations for asset managers and donors willing to explore such structures. And finally, Sandrine Salerno, director of Building Bridges, will then close our webinar. Before we start, so quite a packed agenda, and before we start, a few housekeeping points. As participants, you are muted by default. You can submit your questions or ask for clarifications at any time during the webinar through the chat functions. Our speakers will be answering the question at the end of their intervention, and there will also be some time at the end of the webinar for all remaining questions. With that, let's start and welcome Adrian Schatzmans, the CEO of AMAS, for some welcoming remarks.
Thank you, Aurelia. And dear colleagues, on behalf of the Asset Management Association here in Switzerland, I'd like to welcome you to this webinar. As Aurelia said it before, this webinar is jointly held by AMAS and Building Bridges. There's a very good reason for this. As you know, Building Bridges, of which we are a proud founding partner, is all about bringing people, institutions together around the topic of sustainability from various corners. And to me, there is no better way to live that spirit than with blended finance, bring together private and public money. As we hear and learn later, one doesn't work without the other. Now, today, this is an introduction. This is just the start, but we're very hopeful that next time when we meet and talk about blended finance, we will discuss real projects, concrete initiatives. So this is the beginning. We want to make sure that across the industry, across our association, we share the same common understanding on blended finance, what it is. But of course, sooner or later, this needs to translate into real action. And with this, Aurelia, I hand back to you.
Thank you, Adrian. I'll now take a moment to introduce the concept on which our speakers will deep dive. And if we can go to the next slide, the idea is to understand what exactly, and then one after this one, what exactly is blended finance. So the principle of blended finance structures actually consists in leveraging concessional finance to mobilize market rate financing in order to rebalance the risk-reward profiles of investments that otherwise, without this risk balancing, would not proceed on a strictly commercial basis. So we really see that it requires such investments that are common good investments as related to the SDGs, so Sustainable Development Goals, are so complex to tackle that it really requires this multi-stakeholder, public and private approach, as no one can solve those challenges on its own. So blended finance really is really this financing structure in which concessional money really acts as a catalyst to mobilize commercial money, and we'll deep dive more into what are the different approaches and it can look like a bit later during the webinar. But what's interesting is that you can really achieve different types of investors, can really achieve different type of goals through that structure. And with such innovative and catalytic instruments, you can have, on the one side, commercial investors looking at achieving their market rate, and they will achieve their market rate, while concessional donors will mostly have an impact focus, and together they can side by side reach their own goals and tackle and achieve the related SDG that they have in mind. If we go to the next slide, the OECD came up with 5 different principles to efficiently use and set up blended finance structure. Since it's a multi-stakeholder approach, it requires a few principles. First one is really about making sure that there is a clear rationale for the concessionality of blended finance. The second is really about the fact that we shouldn't go too much. I mean, the concessionality needs to be limited and left to the minimum, really acting as a catalyst, but that there is an efficient use of this concessional money. The third one is that the initiative, the project needs to be commercially viable ultimately. So there needs to be this goal. The fourth one is really about making sure that market failures are addressed and markets are reinforced in the areas where those investments are made, so that it really tackle this catalyst aspect, so that it paved the way for new and fully commercial money in the future. And fifth, really promoting high standards. Now, if I go back to a little bit on the asset management industry, most of you and some of you are obviously our members and have an asset manager's role, which is that as an asset managers, we go to the next slide, asset managers have a clear role. They act on behalf and in the interest of their clients to find the most attractive investments opportunities. So SDGs is not their primary mandate, and therefore blended finance really represents a key opportunities for asset manager to align the finance with sustainability goals and to really channel commercial fundings in areas and countries where it's most needed, while still achieving their return objective. And I think that that's really important to understand, and that's the reason why it's a key opportunity. Blended finance tool really enables asset managers to de-risk their investments, to achieve the targeted investment returns, while also reaching the required volume to achieve specific sustainability objectives. So that was my introduction. Now we're going to understand why blended finance solutions are critical for the Swiss Confederation and for Switzerland as a whole, through the contribution of Liliana Kirchknopf from SECO.
Hello, everyone. Thank you very much, Aurelia. My name is Liliana Kirchknopf, and let me warmly welcome you also from SECO side, the State Secretariat for Economic Affairs. Within SECO, I'm sitting in the Economic Development and International Cooperation Department. And our partner countries are typically middle-income countries, and our mission is to contribute to poverty reduction and to contribute to selected SDGs, the Sustainable Development Goals of the UN, through economic cooperation. We do this together with the Swiss Agency for Development and Cooperation, our sister agency in the Ministry of Foreign Affairs. So just that you understand where I'm located and what our mandate is. Now, blended finance really has become a buzzword when it comes to the SDGs and impact investing. And let's try to unpack it for you. Aurelia has made a start to say it's basically combining public and private or philanthropic and commercial funds. It's not a new concept, but it really has accelerated in its meaning and its in application when it comes to financing the SDG gap. Latest estimates talk about more than 4 trillions that are needed to finance all the SDGs. So clearly this cannot only come from the public side or from official development assistance budgets, but it has to come from all sides, including the private sector and the financial sector. And of course, what is required is a sustainable business model and that we can help to leverage private capital in this process. Blended finance is a mean to an end, and it can take different shapes and forms, and it doesn't always necessarily need to involve concessionality. I will also give you some examples. It can be enough simply that you combine public and private funds and to give some comfort sometimes to the private sector to go into initiative, but at the end, no concessionality is needed. When I look back, a lot has happened in the last years. I started to get involved in impact investing in 1999, and then this terminology didn't even exist. And the investors were mainly multilateral development banks like the Inter-American Development Bank, or IFC, the International Finance Corporation of the World Bank Group, or a Triodos Bank from the Netherlands. And then pioneers like Responsibility, Blue Orchard, Symbiotic started their activities in Switzerland. And SECO teamed up with many of them in the early days. And over many years, innovative public-private partnerships were fostered. And today, Switzerland is a world leader in impact investing, managing a third of global impact investments into emerging and frontier markets. However, if you look at the share, then impact investing represents only 5% within the sustainable investment approaches of Switzerland. It's still a niche, but it has grown tremendously in the last years. So that's why I'm really pleased that AMAS has put together this webinar together with Building Bridges. We see several financial centers around the world positioning themselves in this area of sustainable finance, including impact investing. And we have a chance to remain at the top, responding to new public pressures and customer demands, and contributing ultimately to a greener and more equal world. In short, with all the crises, global crisis going on, we need to find a way to create a virtual cycle. And it's interesting to see that in the last years, big players abroad have taken over several Swiss impact asset managers, confirming that this is a growing market and there is an invaluable expertise in Switzerland. So zooming a bit down to SECO's work, we in economic cooperation and development, Parliament grants us every 4 years funding. And currently we are a midterm in our strategic cycle spanning from 2021 to 24. And the cooperation with the private sector is thereby key and will be important, will continue to be important also under the new strategic cycle 25 to 28. Normally, a big part of our work is really improving framework conditions, so supporting structural reforms, improving public financial management, or in general the business environment in some countries, helping to streamline import-export regulations, or introducing a sound legal environment for infrastructure investments. But we see that this is not enough, and we need to complement this work with demonstration projects, and also to work hand in hand by showing that actually investments can be done also in challenging environments. And that's why you see around the world development finance institutions, and in Switzerland we have SIFEM, the Swiss Investment Fund for Emerging Markets, who is investing in those countries. It's fully owned by the Swiss Confederation, and it provides patient capital. It invests mainly in funds that then typically on lend to SMEs. CIFEM is governed by a strategic framework whereby it gets some targets that it has to fulfill in terms of impact it has to generate, but it has also to be profitable. And this and it really shows that impact and return can go hand in hand. We don't talk about double-digit returns, but in the single digit, and it has shown consistently over years, like the multilateral development banks, that you can invest profitable in these markets. And I mention CIFEM because there might be opportunities for some of you to co-invest with CIFEM going forward, and to benefit also from the long-standing experience of CIFEM, which would be also sort of blended finance, since the capital of CIFEM comes from the Confederation. And CIFEM, the portfolio, the management of the portfolio of CIFEM will be taken over as of 1st of March by Responsibility following public tender. Then besides CIFEM, you may want to team up with multilateral development banks, which have even a longer history of impact investing. The lead for multilateral development banks is at SECO, and Switzerland is a shareholder in these institutions like the World Bank, IFC, the EBRD, the European Bank for Reconstruction and Development, the Inter-American Development Bank, Asian African Development Bank, and the Asian Infrastructure Investment Bank. And we are represented at the board with SECO and SDC colleagues, either at the executive directors level or at advisor level. And we're happy to, to make connections if this is helpful, because many of these banks have different investment vehicles where they also operate with blended finance structure, either because they get some blending from donors or from philanthropic foundations. And this can be a helpful way to get into this space with a very experienced partner. And then let me mention our new flagship initiative, the SDG Impact Finance Initiative. You see it on the screen. It's a new initiative that SECO, together with SDC, with UBS Optimus Foundation and Credit Suisse Foundation, have launched at the end of 2021 at Building Bridges. It brings together our long-standing experience, but also having developed this initiative in a co-creation space with many actors in Switzerland, and basically looking what is still missing and how can we leverage the expertise that is being around. So in that sense, the SDG Impact Finance Initiative is complementary to a CFEM, for example. We can continue, and maybe we can skip some of the slides if you don't mind, Aurelia. Yes, we can skip that or continue. Here you see just the ecosystem, and by now there are new players, so it's a very dynamic space in Switzerland with many players, and I think it's reflected today in the participants coming from, you know, asset managers, but academia also, NGOs, and so on. So international organizations. So it's really a space where you just don't blend the finance, but also the expertise. We can continue. Yes, let's continue. One more. Yes, so we have by now about 32 million together, and the goal is to raise 100 million to finance new innovative initiatives and to unlock 1 billion in capital. So a ratio of 1 to 9 or 1 to 10, depending how you calculate, which we think is ambitious but realistic based on previous programs and projects we have funded. We can continue. The initiative has basically three windows, and I will just briefly mention them in the interest of time. The first window is to support innovative new initiatives that are early stage. So you may need a feasibility study, you may need a proof of concept, and you need some funds for that. Very often we see also that new initiatives spanning over several SDGs or so on are more complex to set up, and they would not happen just by itself. The second window will be more on scaling. You have a fund together, but you need the last push for getting, for example, institutional investors on board. And so you need, for example, a guarantee or a first loss to get this security. And the third window will be more on the ecosystem. Let's look at regulatory issues. In Switzerland, for example, retail solutions are not yet there in the impact investing space, tax issues, impact measurement methodologies. And this initiative will work through open calls for proposals. That's for two reasons important. One, in terms of transparency, that we know what is out there, but also others learn what kind of initiatives are being developed. And the second part is value for money. We can really compare and select the best proposals, which is of course important when you use taxpayers' money. So with that, I'm pretty much sure that I have used my time, but I remain at your disposal and happy to also forward additional information. The first winners have been selected under CFI, 7 winners. You can Google them, or we will send you the information. Thank you.
Thank you very much, Liliana, for this very interesting presentation, and on CFI as well. I'm sure, I'm just looking at the time if there are some questions, but not yet. That's great, and we can take the question at the end. So let's deep dive to, let's move to Chris. Thank you, Chris, for joining. You'll deep dive into the technicalities and the different approaches out there that are used in the blended finance scape. So over to you.
So hello, everybody. My name is Chris Clubb. I'm from a group called Convergence Blended Finance. We've been around since 2016. We're just 100% dedicated to best practices, good practices in blended finance, to be mobilizing a higher level of investment, indeed targeting private investment to our target markets. Thanks. We'll start with this slide. So this repeats a slide that was presented earlier by Aurelia. I just really want to focus really on two things here. First and foremost, all blended finance transactions include at least two forms of capital. Private investment, where that private investment is looking for a market or a market-beating risk return. And secondly, funding from a philanthropic or public sector organization that is allocating that money really from their perspective primarily to achieve what they would describe as development impact or climate impact. Therefore, all blended finance transactions are fully aligned with one or multiple investment themes or strategies of ESG, green finance, impact investment, climate finance, net zero finance, SDG investment. None of the philanthropic or public sector organizations will allocate any of their money unless there's a strong impact story there. Therefore, when one is an asset manager or an asset owner participating in blended finance, by definition, you are participating in transactions that have strong ESG mandate or green finance or climate finance. The second thing I wanted to say here, blended finance in and of itself is engaged. It can be done in developed countries like Switzerland or the European Union, but is primarily practiced today in developing countries. The European Union itself is probably the biggest provider of concessional or catalytic funds to mobilize investment within the European Union, either for SME financing, research and development, or climate mitigation financing primarily. Whereas outside the European Union, in low and middle income countries, there's many organizations, and I really want to applaud Liliana and SECO for their leadership in mobilizing investment to low and middle income countries. Now, when it comes to low and middle income countries, I want to start with one very important issue here, is that the country risk in low and middle income countries or emerging markets and developing economies is generally quite high. Indeed, the median sovereign risk rating in these 142 countries is single B. Therefore, by definition, we start with a big problem, that the country risk sometimes overwhelms the individual risk of the company or the project, and therefore blended finance at its core is trying to alter the risk to make it acceptable from a risk return perspective for private investors, whether they're asset managers, arrangers, or asset owners. Next slide, please. Now, the next slide really depicts, if we've all taken, Finance 101 or Investment 101s, this is the capital asset pricing model for debt investment. And on the right-hand side, we model risk and return. Okay, now if we look at the bottom here of this whole idea of, well, what level of risk do we face moving from AAA to CC from a debt investment perspective? All investors would have a red line here, beyond which they're not able to invest because it's just simply too risky, whether that's BB or BBB or indeed single B for some, but for most investors, it's around BB or BBB. Unfortunately for us, many of the country risk in these countries is high, as I said, single B. So many investments lie to the right-hand side of this red line. So the core of blended finance is moving an investment opportunity to be on the left-hand side of this red line, i.e. to be acceptable risk, and also to get it to the market efficient line, the upward sloping line. So blended finance either moves a transaction or portfolio of transactions from A to B, therefore decreasing the risk and getting it to a market efficient line, or just simply outright subsidizes a transaction to get it to market efficient. It can do either, but broadly speaking, most transactions today, it's about decreasing the risk, i.e. getting it from the right-hand side of this line, red line to the left-hand side of the red line. Next slide, please. Now, in general, there are 5 common archetypes of blended finance, but I'm really going to focus on the first 2 here today. And those are really oriented around altering the risk and risk return of a transaction. So one can either be deploying funding that is concessional or below market in order to mix with market-based returns to basically create either a weighted average cost of capital that is lower or a level of subordination to increase the risk return of the commercial investment happening. Similarly, a guarantee or insurance can be deployed. Obviously, a SECO government guarantee really increases the risk to AAA. That's a relatively simple, but maybe an inefficient use of Swiss government and other government resources. Next slide, please. There are other forms or archetypes of blended finance, and I really want to applaud SECO for leading 4 Swiss partners in this design stage grant. So the SDG Impact Finance Initiative, which Liliana was just talking about, is an excellent global example of a different form of blended finance to mobilize higher levels of private investment to low and middle income countries. Next slide, please. Because you're mostly from the asset management community, I'm going to focus on some of the hard financial structuring aspects of blended finance over the next several slides. So we've engaged a lot with many asset managers, investors, asset owners over the last 2 years. And there's been a strong identification that there are some very effective and efficient blended finance structures. I'm going to start with the first when we're trying to get debt investment into low and middle income countries. So this is a blended finance vehicle, usually structured as a fund of some sort. Indeed, our colleagues at Blue Orchard have been doing this for many years in Switzerland. And the way this generally works is we create a vehicle, let's call it a fund, with many asset managers creating funds like this, where there would be 2 or 3 tiers of capitalization of this fund. And the senior tier, generally speaking, would be in rated investment grade or BB. And then subsequent lower tiers, which are usually invested in by MDBs, DFIs, or philanthropic or public organizations, would be rated higher risk, with the whole idea of really shifting the expected loss of a portfolio of debt investments. And each debt investment can be a loan or can be a bond or a combination of the two. But imagine a portfolio of debt investments as bonds or loans, whereby the capital structure means that any losses or defaults really accrue to the most junior tiers of this blended finance vehicle, thereby credit enhancing the senior tiers up to investment grade and really reducing the risk of loss. This is a typical blended finance structure, and we can really credit enhance the senior tier up to single A, triple B, or double B based on the risk profile of that portfolio and the level of subordination in this structure. Next slide, please. This just illustrates from an expected loss perspective how the expected loss decreases by approaching this structure. Next slide, please. And I'll give you an example, and there's several in the deck that can be distributed later, of a blended finance structure from global partnerships that has been structured using this particular structure. There are around 100 blended finance funds or structures that have used this technology, that have implemented to mobilize debt to low and middle income countries. You can follow up with me. We can share with you what they have been, but this is a typical structure and a typical approach. Once again, investors looking at a portfolio or individual, well, in this case, a portfolio of debt investments and being credit enhanced up to investment grade or near investment grade and getting a market or above market return through blended finance. Next structure, please. Next slide. Yep, perfect. Thank you. This is about mobilizing equity investors into equity investments in low and middle income countries. Once again, we take a typical blended finance structure. This is a fund or a blended finance vehicle that has multiple tiers of capital. This is less about distributing defaults and losses to the junior investors. This is all about funds coming into, let's say, a traditional limited partner, general partner fund structure, whereby there's a different seniority and a distribution based on the distributions coming out of the fund back to the limited partners over the course of time. Essentially what happens, all the money comes into a fund manager. The fund manager then places that in 8 to 15 different equity investments. And then in years 5 through 12, when the investments are realized, the funds are distributed asymmetrically back to the senior investors, thereby increasing the speed in which they've achieved an internal rate of return of 0. It increases the likelihood of them getting their money back, and it actually improves the distribution of outcomes for them, with once again the junior investors more or less being at a higher level of risking their loss. Next slide, please. And this graphically demonstrates how one can alter the distribution of returns. So the orange line here is a non-blended finance structure, and the blue one is a blended finance structure whereby we're increasing the returns for the investors. Next slide, please. And a classic example of this is where in Denmark, where the Danish Development Finance Institution, IFU, teamed up with the Danish government to mobilize Danish institutional investors. They've done this 3 times now successfully, originally in agriculture, secondly in climate, and now they have something called the SDG fund, where they've mobilized in excess of $1 billion, don't quote me on the currency, I think of euros, in the SDG fund to be invested in equity investments in emerging markets. Next slide, please. I'm going to walk you through a little bit of moving away from the nuts and bolts now, just walking you through to really what is going on in the blended finance environment at this point in time, or the market. Next slide, please. So at Convergence, we publish every single year some information, and it's available on our website, called the State of Blended Finance Report. We try our best to look at that world of blended finance that includes an amount of concessional capital coming from a public sector entity like SECO, or a concessional philanthropic organization, let's say like the UBS Optimus Foundation, whereby that money is also mobilizing private investors. So we have the world's largest database that, if you follow up with me, we can give you access to. There's around 160 billion of financing that has been mobilized in around 750 transactions. And this is the annual level of flows. There are around 50 individual blended finance transactions happening each year, and for a total of around 12 to 15 billion of investment on an annual basis. Next slide, please. Now, there are many structures for this blended finance activity, and we've listed here what have been the most prevalent structures that have been deployed. As you can see here, the most prevalent form has been a fund, similar to the debt fund that I showed earlier, or to an equity fund that I've shown earlier. Generally speaking, we expect a higher level of funds really set up by fund manager or asset managers, fund managers, to be, and you can see out of all the transactions that are in fundraising mode on the right-hand side, indeed, 62% of the structures have been set up as a fund, either a private credit fund or a private equity fund in general. Next slide, please. Where has the money been flowing to historically? Broadly speaking, 3 big areas, okay? One has been agriculture, has been a big recipient of blended finance flows. Energy, usually renewable energy, climate mitigation projects, and therefore net zero and green finance, climate finance, ESG, environment, has been a big recipient of blended finance flows. Financial services has been a big area, generally not to bolster the financial institutions themselves, but to deliver a form of financing through financial institutions. So, for example, for small and medium-sized enterprises, financial inclusion, or for agriculture through financial services. On the right-hand side, I have to flag infrastructure. This is the percentage of transactions. Although infrastructure doesn't show as a high percentage, your average infrastructure transaction has been very, very large. Therefore, infrastructure, especially climate infrastructure, has been a big recipient of blended finance flows. Next slide, please. I'm going to wrap up with one more slide and just kind of, sorry, go back one slide, please. No, yeah, this slide here. Just want to show you, based on the data that we have accumulated, here have been the main organizations that have been participating in blended finance transactions between 2015 and 2020. We have this data disaggregated if you're interested, and we broke it into 5 categories, okay? The development agencies or multilateral funds, these organizations have been the ones deploying concessional or below market capital for the purposes of mobilizing private investment. The multilateral development banks and development finance institutions, these have been very involved, but in general, they're deploying market-based financing. The impact investors that have been involved and the commercial investors that have been involved, these organizations are deploying funds for the purposes of making a market or above market risk return, while at the same time trying to achieve impact investment or ESG positive investments. And the philanthropic investors on the right-hand side, generally, they have also been participating on a below market term for the purposes of mobilizing private investors. So with that, I'm going to wrap up and pass back to you, Aurelia, and others. And once again, please share the slide deck with everybody, because there's incremental slides thereafter. Aurelia?
Great, fantastic. Thank you so much, Chris. I see there are quite a lot of questions on the chat. So the slides will be shared afterwards to the participants. So that's one. A question on the CFI windows. Would there be other windows open? That's for you, Liliana. I guess yes, if you want to briefly answer that one.
And Aurelia, I would also say, if anyone wants to ask any questions, I'm going to be online for the next period of time. I'll try and answer the questions in the chat box.
Perfect. Maybe Liliana, you want to take that one?
Yeah, briefly on the other windows, because we had started last year with window 1. There is a plan to have open call for proposal on window 2 still this year, but it may take a bit more time as we are staffing the organization. So be a bit patient, but window 1, there will be a call in the next months. Thank you.
Thank you. And then I propose that we keep the other question for the end and pass it over to Leticia Ferreras for a concrete example of the Allianz and IFC facility and deep diving into the implementation and what were the challenges and the recommendations you may have also for the asset managers who are willing to jump on such blended finance solutions.
Wonderful. Thank you very much, Aurelia, and hello everyone. So Aurelia briefly introduced myself before, but I'm Leticia Ferreras. I'm one of the portfolio managers in the development finance team at Allianz Global Investors. Just so you know the context, many of you might know Allianz Global Investors is one of the asset managers within the Allianz Group, the large German insurance companies. And specifically what we're focused on is creating private debt strategies to mobilize private capital towards emerging markets in support of the achievement of the UN SDGs. And of course, blended finance is based in very much the core of what we do in the team. So following Chris's very eloquent description of blended finance and all the different aspects, we wanted to also give you a sense of a practical example where this works, and also tell you a little bit about the challenges and the benefits that exist in blended finance, both for private investors or commercial investors, as well as the public sector that would be providing some of that junior capital. So without further ado, on the next slide, I wanted to introduce you the Allianz IFC Blended Finance Partnership. So maybe to give you a bit of context as to how this came about, back in 2015, so as you can see, the Allianz Global Investors, we've been in blended finance space for quite a few years, but starting off in 2015, the IFC approached Allianz as the large insurance investor, and with an intention of creating a partnership to be able to continue deploying capital in emerging markets. At the time, IFC was going through some liquidity constraints, but they wanted to continue, of course, making the high impact investments across emerging markets. So they were looking at the institutional world, so meaning insurance and pension funds, to create a vehicle that would allow the IFC to continue doing what they were doing and what they're very good at, which is, of course, deploying in emerging markets and promoting infrastructure, economic growth and development, and then also providing investors, as we'll see, with several benefits when it comes to portfolio diversification, entering the impact investment world. So looking really to align incentives and to also solve the issue that they were facing at the time with regard to liquidity. So at the time, that's really how the partnership started to be built out. It was the first time that Allianz was looking into blended finance, and as many of the team members that were involved in the original vehicle like to say, we didn't really even know that it was known as blended finance at the time. So it was really very much an approach to how do we structure a vehicle where all the incentives are met from all the different parties, and we're of course able to to mobilize a significant amount of capital. So in terms of the structure, maybe to start what you see on the screen, it aligns very well actually with one of the screens that Chris was showing you earlier. But the idea is that at the time when Allianz was evaluating this investment, they looked at the underlying pool of loans, and they obviously identified that most of them were sub-investment grade. And what they came back to IFC with was saying, well, we are very excited about this opportunity. We would like to enter emerging markets. We're very much excited about the possibility of impact investments and contributing to emerging market development, but we're not quite ready to take on the full-on risk that comes with investing in these markets. So are you able, IFC, to come in and provide a junior capital / a first loss tranche into a vehicle, so that, as Chris explained earlier, by absorbing the first losses into a portfolio, the risk profile of the Allianz investment becomes closer to investment grade. So that's what the blended finance vehicle looks like. Essentially, as you can see on the right-hand side, it's a combination of private capital coming from Allianz investors that take a senior position in a vehicle, and they are de-risked, or they basically benefit from the existence of IFC in partnership with SIDA, the Swedish Development Agency, that provide a junior capital into the fund. This means that the junior capital is essentially taking a more junior position, and then, as the name indicates, so that to the extent that there's something goes wrong in the underlying portfolio, which I'll touch on in a second, this junior capital absorbs the first losses. So of course the seniors are able to benefit from that buffer. I will say, as you see the senior and junior structure, this is essentially one of the key benefits for blended finance, and we'll see that in a slide ahead, where the concept or the risk profile that equates to investment grade is very key for institutional investors, for the vast majority of them. So being able to structure vehicles in this way becomes very important to really deploy scalable amounts of capital. And maybe to refer back to one of Liliana's points earlier, I will say that in this vehicle, both Allianz as well as the public capital providers, so IFC and SIDA in this case, benefit from a return. So even though in some cases that public capital or junior capital can be concessional, meaning no return is required, in this case and in many of the vehicles that are structured in the market, there is indeed a return that gets earned. Of course, is a higher risk, but the return in many cases compensates for that the risk taken as well. So that's from a structuring perspective of what the vehicle looks like. Now, if we look at what it invests in, we're looking at a portfolio of loans that are originated by the IFC. And these loans originally were only focused on infrastructure assets, so very much sustainable transport, energy, etc., across global emerging markets. As you can see, we have a very diversified portfolio, and this is very much on purpose. As you can imagine, the more diversification, the lower is the correlation, and then of course the impact of one loan defaulting is much lower on the basis of the vehicle. So this is very much a target and a requirement for the portfolio. To give you a sense of how well this vehicle has worked, the original vehicle closed back in 2017 at about $550 million. And as of last October, we announced that the vehicle had doubled in size. So we'll talk a little bit about some of the challenges and benefits in a second, but overall it has been a very strong partnership where we were able to meet the IFC's targets when it came to being able to continue originating. And of course, as an IFC, as a partner, the IFC is bringing their strong expertise, the track record, and their local presence, which was essential for an investor like Allianz that was essentially at the time dipping their toes into blended finance and emerging markets. So maybe this is the kind of the overall status. The vehicle itself is already very much in deployment, but maybe to go into the next slide, we can go through some of the benefits of this vehicle for both types of investors. This is very much obviously in a way tailored to the vehicle with the IFC, but equally, it applies very much to a lot of the blended finance vehicles that are being created and have been created in the market. So on the one hand, as you can see, the large bubbles, from an Allianz perspective, given the risk appetite, what they were really looking for was in being able to invest in an investment grade risk profile type of asset, which is this fund, and in emerging markets, which I think somebody might have mentioned earlier, but about 80% or more than 80% of emerging markets at a sovereign level are sub-investment grade. So there's not that many ways of accessing EM in an investment grade type of risk. So this was essential when it came to the structuring of the vehicle. It still generated attractive target returns. I think this is an important point, especially for many that might be in the audience and talking to different investors. Sometimes, and I say this quite practically, sometimes investors that are not as familiar with blended finance have an understanding that when it comes to impact, we're thinking about sacrificing returns, and that's not the case, at least for the vehicles that we look to structure. So in this case, Allianz investors are still benefiting from an attractive return. It's a very much a diversified portfolio in itself, and then also provides diversification in the overall portfolio of Allianz investors when it comes to their strategic asset allocation. It is, at the end of the day, emerging markets private debt exposure, which is an important addition to many other assets that are held by insurer balance sheets. And then by virtue of the partnership with the IFC, which is, as many of you know, is a very strong, one of the largest investors actually in one of the charts that Chris showed. They have a very strong track record. And then on top of that, by virtue of being a multilateral, they benefit from a lot of kind of political regulatory exemptions and concepts such as the preferred creditor status. So by virtue of partnering with them, we're able to mitigate the political and country risk, which is, of course, a key concern for a lot of investors. So we can dig a little deeper later if there's any questions and go into that. And then another point that I did want to highlight that you see above is that institutional investors look to deploy scalable amounts of capital. So in many cases, they look to invest in large funds. And this is the reason why the vehicle has doubled. One of the reasons the vehicle has doubled in size, and the ability of blended finance vehicles to be scalable is essential to continue mobilizing. So it's important from an impact perspective, but also practically for investors to want to go into these, in many of these vehicles, essentially the larger, the more attractive it can be. And of course, from an impact perspective, we should make this bubble a lot larger, because I think that is an important point. I will say also, practically, it is not necessarily the biggest attractive point for some investors, but in the case of Allianz, impact investing and climate-focused solutions is an important point as well. So very much a benefit for this kind of partnership. In the next slide. So the benefits for the IFC were also quite significant. And I think this is important, as sometimes there's a question as to why the public capital is going into these vehicles, and why do they want to invest with the private sector. Going a bit quickly, because you can see it on the slide. The idea is that the IFC was able to access an additional pool of capital through the partnership with Allianz, but continue deploying and doing more of what they were already doing, which is of course important for them in terms of reaching the positive impact and all the KPIs that they're responsible for contributing towards under their mandate. Also, an important point is the KPI related to private capital mobilization, which is an increasing requirement that we see from the development world. There's an understanding now that we need to mobilize private capital to be able to bridge the SDG funding gap. So this type of vehicles are able to do that in a very efficient way. And then the use of catalytic capital is attached to this point. As I think Chris mentioned, when we talk about private and public capital, of course, it depends on the underlying portfolio. But in many cases, we're talking about 10 to 15% of the overall fund can be junior capital and can mobilize the remaining 80 to 85. So in terms of catalytic effect, is actually quite large. So it's considered a very efficient use of the risky capital that the IFC is investing. And maybe to wrap up from my side on the next slide, despite all the large benefits, and this probably would take a full hour to go through, but there's quite quite significant challenges that also is important to mention in the context of blended finance partnerships. I'm happy to expand on these on a one-on-one basis if it's helpful. But I think some of the challenges we faced is commercial investor appetite for sub-investment grade is limited, which then leads to complex structures that have to include this junior capital / first loss as part of the structuring of the fund. Equally, this junior capital / first loss tends to be quite scarce. So fundraising for that type of capital can be quite a challenge in itself. And you see that there's obviously increasing efforts from governments and organizations such as SECO to be able to promote this type of capital. But it is something that overall in the market, it just takes quite a bit of work to find the right investors with this type of risk appetite. Then also in terms of partnerships with the DFIs, there's some vehicles like the IFC one where it is an exclusive partnership with the IFC, which of course leads to some benefits because you're only negotiating with one partner, but equally there might be some deployment concerns with being of course associated only with one partner that is looking for opportunities. So that was something that was discussed at length during the structuring. And then there is an element around data transparency, which has a direct impact on the rate ability of these assets. So meaning it is still a big challenge to be able to obtain an external credit rating for these vehicles. And that has to do with historical performance data not being quite available from some of the development agencies. And this in turn, from a commercial investor perspective, not having a rating sometimes makes it quite a bit of a challenge. So not to close on a negative, in terms of recommendations for many of the organizations today, I will say that blended finance, as we've all explained, is essential really to be able to promote development, and especially in emerging markets, and to achieve the SDGs. My recommendations would be to seek strong partnerships across the public and the private sector, because this is essential, really being able to understand each other and have an alignment of interest. That's usually how we find that things get done. And then really will sound silly, but quite a lot of patience, because we do find that investors, even if they have the same ultimate goals, sometimes speak quite a bit of different language. So definitely good to keep that in mind. We'll pass it on to you, Aurelia, for a wrap up.
Thank you, Leticia. And looking at the question, looks like Chris has done a super fantastic job to answer all questions live. I don't see any questions open, so that's fantastic. You can, of course, always contact the speakers directly if there is any further topic. I'm just looking at if someone wants to have another question. Otherwise, I'll just pass it over to Sandrine for some closing remarks.
Yeah, thank you to all the speakers. It was really interesting to have this first event on blended finance, and I hope we will have a few other moments to discuss around blended finance. Maybe a few words on building bridges. You can show the slide, please. Building bridges, just to remember, is an initiative that has been launched in 2019. It's owned by the Swiss authorities, the International Geneva, also the finance community. AMAS is member of Building Bridges. It is a collaborative initiative. The last edition was in October 22, and the next one will be in October 23. So the ambition is really to drive capital around SDG to move to sustainable finance. I'm seeing that Aurelia is a bit looking about the slide. No worries, you can go on internet, www.buildingbridges.org. You will have all the information. The idea is really to offer you a space to network, to learn, to share the practice, the doubt, the question you have around finance, sustainable finance, and how to drive and build together an agenda around sustainable finance. So I hope Aurelia and all the people that attend the seminar, that we will have more opportunities to talk about impact finance, sustainable finance, but also blended finance within the community of asset managers, but also through the different communities that sometimes work in silos around finance. Thank you very much.
And I would like to thank again all the speakers for such an interesting conversation. We only have 1 hour, but we hope that you get a lot of insights about what is blended finance. It looks like more than an introduction to me, and I'm really looking forward to the next event so that we can deep dive further, look at other examples. And again, thank you to everyone for joining, and first and foremost to the speakers, and looking forward to this collaboration with Building Bridges. Thanks again, and with that I leave you with it's only the time to say goodbye and to the next one. Thank you.